Thank you for inviting me here. As ever, you all get a speech that is a little bit more of a stream of consciousness of the things that passed through my mind shortly before I was due to stand up here. A couple of things that have already been touched on, though, are quite interesting. Thierry mentioned that we are going to have the green paper on long-term investment. I don't know what's going to be in it, but I know I had quite a lot to do with the fact that we're getting it when I set as a priority 2 years ago long-term investment in a tighter regulatory framework as a key response to the Commission. And I had very much in my mind then the kind of perverse incentives that we were already experiencing as a consequence of financial regulation. I'm going to comment, I think, on and around some of the same kinds of issues that Professor Kay has raised, but more in association with how they impinge upon me and us in the making of regulation that is already underway and which is planned. Now, there's an undoubted dilemma at the moment of the seen requirement for regulation to achieve financial stability, the fact that that impinges upon growth, and it's impinging upon growth at a time when lack of growth itself is possibly one of the greatest threats to stability that we're now experiencing. So today we're discussing in this meeting the continual growth of short-termism in financial markets and how to correct it. Short-term behaviour presents huge problems. The most obvious is stability and providing reassurance to end investors who fund by saving our economy and financial markets. One aspect of short-termism, which is very obvious, is high-frequency trading, an area in which Finance Watch has done a lot of work and where many now question whether there are any benefits at all of sustained duration. It may mean that there is better price discovery, but as the Kay review points out, that's not the same as value discovery. Other aspects encompass behaviour and interaction of market participants, including bank traders, asset managers, hedge funds and pension funds. A big determinant in this is the regulatory framework and the responses that regulation forces. What might also be called the complexity war. Greater numbers of and layers in financial markets has compounded the regulatory response, which in turn impacts the investment chains that our economies rely upon. And as mentioned in the Kay review, we need to return to long-term behaviour and investment. As with so many questions about how to get somewhere, alas, the Irish answer of "I wouldn't start from here" is certainly applicable. So many of the points that have already been raised are indications of where, often with the best of intentions, we've gone astray. Too frequent a reporting, all in the interests of transparency, encourages short-term horizons in the thinking of executives. Reconfirmation of directors at AGMs does the same. I mean, has nobody discovered the downside of democracy? You know, politicians seek to please in order to get re-elected. One wonders why you think company directors are going to be made of any sterner stuff when they come up for reappointment. Now, of course, quarterly reporting perhaps no longer being required and only annual reporting is a matter that is before us at the moment, so we might make a little bit of progress there. But whilst on democracy, another of the recommendations in the Kay review concerned the dematerialisation of shares, so not having it in paper anymore. Like a few of the other matters also raised, it's already before us now in the regulation on central securities depositories. And I've already received input from back home that dematerialisation is far too unpopular a measure for any government to support. rather the same as trying to do away with checks. The grey vote counts. Secretly, I suspect that they hope Europe will be brave enough to do it and take the blame. There are also other conflicts, like fragmentation of the investor base, which is seen as a disadvantage to long-term investment and understanding of a particular company. Yet at the same time, when I'm looking at prudential requirements, I'm interested in diversity of portfolios. In some regulations, Solvency II is a good example, diversity is recognised in many ways. I had a much harder job trying to implant recognition for specialisation. That was deemed unmeasurable or too correlated. When looking at assets, a long chain of intermediation means the reliance on numerical measures or indicators becomes dominant over knowing the business. Hence, in all our regulation, there's a reliance on those numerical measures to the extent that the simple know the business is squeezed out. Engagement is seen as vital to keeping long-term interest, and in the Parliament we have been trying to pursue relationship lending within the framework of CRD4. But again, we are coming up against the supervisory attitude of how is that to be defined and measured. Following on from the financial crisis, we've had a lot more concentration on liquidity within regulation, and in general this presses towards trading and the easily tradable rather than locked-in investment. Other prudential regulations clamp down on the instruments, many of which were devised to help businesses, but they're not necessarily deemed to be fully loss-absorbing. Turning to bonds, these are rendered more liquid by the derivatives that surround them, which render a simple investment more complex, and which, one guessed it, is also encouraged by regulation. For investment in infrastructure or production, maybe it would be simpler if bonds or other investments were made for a range of maturities, allowing insurers and pension funds and asset managers that have to match bond terms with potential liabilities to do that matching by purchase of a range of differently dated bonds in the same investment. This so-called liability immunisation is not done that way for a variety of reasons. For example, long bond purchases can be hedged with future contracts to effectively reduce the duration, and indeed they will receive a regulatory reward for hedging. Meanwhile, those buying shorter maturity bonds may also hedge to extend the duration and get their regulatory reward too. In the middle of these futures transactions, which will be netted off from one another, of course, are the banks making a happy profit. The result of all this is that the bond investment chain is not short or simple, and in the end trading takes place with derivatives rather than the investments themselves. You can track a similar kind of procedure happening with equity too. So when a derivative has more liquidity than the underlying assets, we need to worry. These derivatives themselves are draining away the liquidity that the underlying assets would experience if they were the only investment option. So it seems we've put too much chocolates in the sweetie shop so that nobody buys the plain vanilla. The price of plain vanilla is now too dependent on the demand of other financial assets to drive its price. There are many ways we could begin to address these things. I've suggested a few, ranging maybe in language to levies on complexity and also levies on disclaimers, which tend to accompany complexity. Another way that I did try to solve this, at least in part, was to try and give equal treatment to what I termed real economy hedging rather than synthetic hedges. But complaints arose that you could not get perfect hedges by using capital investments, and that the regulatory advantage would therefore not apply. I realise that's a cyclical argument, and I would say that the regulations have to change to allow it. But of course, that's all part of the international consensus of things that come from the Basel Committee and elsewhere. We could look for other ways to try and encourage direct capital investment. This has been done historically in other countries by monetary policy, using window guidance under which investment has been steered to production. Of course, that's what they do in China. The steering can, of course, be strong or weak, and given that we're not really in a command economy, although some might dispute that with some of the operations that are now going on, we'd have to, if we went this way, because we're not really in a command economy, we'd have to go for the weak variety. But that would still mean central banks responding to economic policy choices, which for some is seen as rather controversial. But some of this is already happening by extension of the assets that qualify for repo operations, although those actions are not tailored for the particular purpose of production investment. Again, the Parliament has tried to do a little bit of its own encouragement in that direction, not through monetary policy, but through risk weightings in the Capital Requirements Directive. And we wanted to lower the risk weight for SMEs and also for trade finance. We've also proposed lower risk weights for long-term projects co-financed by the European Investment Bank. I think we realise that this isn't the perfect solution, but we are looking for ways in which to achieve some of the objectives of longer-term investment. Now, as mentioned earlier, greater complexity makes it harder to assess true or absolute value. Instead, as companies have grown more complex in structure and market dynamics increase, a greater reliance of relative value has landed upon us. This ranges from benchmark-based investing adopted by the majority of institutional funds or the market-neutral aspects of some hedge funds. The index or benchmark has no true anchor. It is merely an average and is so often so complex that nobody can truly understand it. The average of two unrealistic positions can look quite sensible. This is one reason why I have been promoting transparency and licensing for benchmarks in MiFID. Again, we get more understanding if how they are structured is in the open. Another issue that we are, or soon will be dealing with in regulation at the moment, concerns the separation of economic interest and legal title of securities. It's not that long ago that some institutional investors were saying that they did not know that the shares that they lent out to facilitate short selling could be voted. Now there's more a need to an awareness of the need to recall shares and to have a transparent voting strategy available to investors. But similar questions arise when you look at the repo market and other forms of securities lending. Again, in the Parliament, I've been trying to start some information gathering and reporting on securities lending in the context of CRD4 and getting a grip on the encumbrance or otherwise of bank assets. But this kind of information would also help in formulating policy with regard to the role of lending and the split of economic and legal interest on investment culture. I guess we'll be doing more of this in CSDs. Other investment choices are made through price-earnings ratios, which, as the K Review points out, factors in earnings beyond 5 years. I've spoken before in terms of simplicity and that there should be no more what I've termed cash flow time travel, bringing tomorrow's earnings forward for consumption today. Price-to-earnings metrics are also time travel, this time of growth assumptions. I've said before that one of the reasons that growth is scarcer now is because of cash flow time travel effects. We are entering the time zone now that has already been raided for its growth and profits. Unfortunately, we cannot do back to the future, and what we have to do is remain anchored in the reality of now. And that's part of the culture change required to bring genuine long-term investment and absolute value. But how can we change all this behaviour and indeed the regulations? Some of it is addressed by looking at issues in banks like bankers' bonuses. And I'm pleased that today I see my idea of payment in subordinated debt, which I put forward in 2010 in CRD3, is back onto the agenda. We did put it in CRD3, but it got watered down by the UK and the FSA, so it's quite nice to find the Bank of England coming out behind it today. And of course, we have already got it on the boil again in CRD4. And if you'd like to know what else I might suggest to go alongside these things now, I would say that the instruments would have to be made bail-inable, to have a limit on the coupon, and to prohibit packaging with derivatives that would in effect transform it away from taking the risk. So, you know, been there doing it. But to address wider issues of short-term culture beyond remuneration, we have to wage war on complexity and be prepared to take on vested interests. Some of the change to simplicity might even manifest itself as a reduction in measured GDP, although maybe not a reduction in useful GDP. That's a whole new interesting debate for another day, but there will be strong vested interests at governmental level as well as at institutional level in trying to go down this track. Greater regulation itself, as some of the examples I have given and as John Kay has said, may drive even greater complexity or short-termism. Now, there's no future in Brussels to say we should have less regulation. I've been here long enough to know that. But we should be more aware of what it is doing and its interactions. So at the start, I agreed with John Kay that for assets we need more attention to absolute value and less attention to relative value. For regulation, we in fact need the opposite. With simpler markets, simpler products, simpler investment chains, then we can have less absolute regulation. But because everything is simpler, then we have more relative regulation and a safer environment. Thank you.